You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it is time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. If you haven't had a chance, check out our latest addition to the network. It's our lucky 13th program, Options Oddities. We do that every day over there on the TD Ameritrade Thinkorswim platforms. Or if you're a client over there, think about becoming one, surf on over and check it out. You can join us live every day in the chat room and see how the sausage is made as we record that show live every day. It's pretty fun. Of course, you can also find it in the archives on the mothership, theoptionsinsider.com, as well as iTunes, Stitcher, Aha Mobile, wherever you find your finer podcast programs. And of course, via our mobile app available for iOS, Android, and the Fire OS. No shortage of ways for you guys to check out the show and let us know what you think. Use those comment tabs, those feedbacks, those email buttons, and social media. Give us your questions, your comments, your insight. We love to hear from you on all of our programs. And I'm joined, as always, on the Volatility Views program by my usual cohorts, my volatility compatriot, starting off with the major domo of research over there at BGC Partners, Mr. Jared Woodard. Jared, welcome back to the program, sir.
It's always a pleasure to be with you, and I'm really happy to be with you today in particular after this fantastic week in the market.
Yes, there's a few things to actually discuss this week, which should be pretty fun. And I'm also joined by my other volatility compatriot, beaming in from the great state/principality of Maine, Mr. Andrew Giovinazzi from Option Pit. Mr. G, welcome back to the show, sir.
It's been a while, it feels like, on the Volatility Views.
Yes, you remember how it works?
We discussed something about lobsters.
Yes.
Yes,
exactly.
Jared lives in New York now. The Statue of Liberty. I don't know.
You'll figure it out.
You discuss something.
It's like riding a bike. Once you do it, you never forget.
I'll give it a try.
And Jared was right. We do have a lot to talk about this week. It was a crazy week. But before we even get to that, we have a great guest joining us today. So let's dive right on into our Volatility Viewpoint segment.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
All right, everybody, welcome to the Volatility Viewpoint segment. This is indeed the portion of the show where we welcome on practitioners, traders, academics, all sorts of people from throughout the world of volatility trading and analysis and research, and proceed to pick their brains for the benefits of you, the listener. And you guys know on this program, we talk about a wide array of volatility and volatility-related products, and we've touched on some interesting potential new additions to that space on recent episodes. So we thought, who better to bring on to the show than the guy who's behind one of those, He is Scott Nations, the president and CIO of NationsShares. You guys may have also seen him popping up on CNBC all the time, including his own program there called Futures Now. And he's even written a few books you may have heard of, Options Math for Traders, that came out a couple of years ago, and the complete book of options, spreads, and combinations that's going to be coming out sometime this year. So one to look forward to. Scott, glad to have you on the program.
Thanks very much, Mark.
And Scott, like we do with all of our first comers here on the show, I just kind of did a cursory overview of your background. Why don't you go ahead and give our listeners a little bit of an overview of your background in the options and derivative space and how you found your way to getting involved with NationsShares and the whole volatility space?
Certainly. Well, first, let me point out that my second book, Complete Book of Options, Spreads, and Combinations, and I appreciate the plug, actually was published this week, so it's available now.
Oh, there we go. So my material is dated here. I was a week off, but that's good to hear. We can check it out now.
But I've been an option trader for a long, long, long time. I spent a tremendous amount of time in the options pits on the CBOT, Board of Trade, trading options on Treasury futures. And from there, my firm asked me to go start an S&P option trading operation. And so I left the Treasury option pits and went and started an operation trading options on the S&P and did that for a long time. So I've been an option trader for nearly 20 years, moved upstairs in 2002. And it was when we were upstairs that we realized that we could actually create a better volatility index. And we started doing that, and we used it ourselves internally. And that is really how VolDex evolved. And quickly, VolDex measures implied volatility the way, as traders, we always looked at it. When you'd walk back into the pit or you'd sit back down at your desk more recently and you'd ask, what is implied volatility or where is the option market? What you really meant was, what is at-the-money implied volatility? You might ask, what is the at-the-money straddle? And so we realized that the VIX, which has a tremendous following, doesn't do a good job of really explaining what at-the-money implied volatility is. So that's how we came to create a suite of option price indexes. Not only do we have one that measures implied volatility, but we also measure skew, which is particularly important in the equity index world. That is Skewdex, and on the S&P, that ticker symbol is SDEX, SDEX for Skewdex. And we also realize that a lot of people are interested in knowing how likely some sort of tail event is in the equity index world. That is, how likely is the market to have a big move down in the S&P. And so we created the Taildex as well. And that's a measure of how expensive protective options are, that is, put options in the S&P to protect against a 3 standard deviation move to the downside. So that's our suite. And the ticker symbol for Taildex is TDEX, TDEX, and along with VolDex, ticker symbol VOLI. That is our suite of option price indexes on the S&P. So that's really, we came about the suite of products because we're option traders, and we've been option traders for a long time, and we're looking to create gauges that express how expensive options are the way we look at options.
You know, it's ironic that you would choose to go this way because people who've watched VIX for a long time, of course, know there were earlier incarnations of VIX, and the earliest incarnation was essentially, it was on the OEX, it wasn't on the SPX, but it was somewhat analogous to what you're talking about. They didn't have a lot of the other inputs that they have since added when they moved it to the S&P 500, and they started adding things like the skew, for example. They started allowing the skew to input it, you know, of course, the call wing and the put wing. And it sounds like you're almost hearkening back to, I hate to call them the good old days, but the old days of VIX when it was, perhaps you could say, a little bit more pure implied vol product, didn't have as many other hands in the cooking there.
Well, you make a great point, and we think that the CBOE actually had the right idea when they got started. I mean, it's no accident that that's where they went originally. The problem with the original VIX, the VIX that you've referenced, is the fact that you had to kind of reverse engineer the number. That is, you had to solve it by trial and error. Well, we've used some much more sophisticated math to generate a closed form solution that allows us to put option prices in and get a result, a number on the back end, rather than the original CBOE solution, which really was, you could only solve it by trial and error. And so VolDex, again on S&P, the ticker symbol VOLI, is a much better solution than the original VIX, but also you mentioned it's a much better solution than the existing VIX. And that's because, as I said earlier, nobody ever walks into the pit or sits back down at a desk and says, please give me a strike price weighted average of every non-zero bid for every out-of-the-money option in the front 2 months. Nobody does that. And there's a reason nobody does that. It's because, as you mentioned, having all those put skew and call skew options in there, it just creates a bunch of statistical noise, makes it much more difficult for the VIX to express what people want it to express, and that is how expensive are options.
You know, that's interesting you mentioned that, because you're right. We used to go get the old straddle runs back in the day and even today. And yeah, usually it's an at-the-money straddle run across the term structure. You're not really looking at the various skew elements. And yet the CBOE did feel a need to add that to the calculation. They felt it added some data, some value to the end user at the end of the day. You're kind of going back out now and somewhat stripping that out. Was, in addition to getting that pure at-the-money implied, was your motivation perhaps looking at some of the debate that sprung up over VIX settlement in the last couple of years and people complaining of, let's say, stuffing quotes and otherwise meaningless puts and allowing that to affect the settlement value? Was that one of your primary motivations when you decided to essentially strip the skew out of a product like this?
Well, what we were really trying to do, again, was to look at implied volatility the way that we measure it, the way that we look at it, and to eliminate the statistical noise that is inherent in the VIX methodology. Now, we're not saying that having all those options in the VIX calculation, that is, it's bad. We're not saying that complexity is bad. We're just saying that it camouflages the real number that we're interested in, and that is, again, the at-the-money implied volatility. And we'd much rather break out the components of VIX and measure them differently, which we think is a much clearer picture of what's going on. So by having VolDex talking about at-the-money implied volatility, and then Skewdex talking about put skew, and Taildex talking about put tail options, we think we give a much clearer picture of what's going on.
Well, as Jared alluded to at the top of the show, and it's no surprise, this was a pretty crazy week from a volatility perspective, both implied and realized. We're moving quite a bit this week. I'm curious, Scott, how did the VolDex perform this week? Did you notice any interesting developments, any interesting moves? What was your take on the week from a VolDex and a Skewdex perspective?
Well, that's a great question. Obviously, VolDex has been up quite a bit this week, as you would expect. But interestingly, skew is not up tremendously, but the price of tail insurance options is up a ton. And so what's going on is it seems that people are obviously buying options. They want some protection, but where they're really focused is either at the money or substantially out of the money. So, but using our suite of products, you can really see where the buying interest has been focused. And that really tells you what people are thinking. Again, that gives you a little bit more information rather than a single number that aggregates every option in the world. It's interesting that Taildex was up quite a bit, about what you would expect. I mean, we would expect it to be up quite a bit in a week like this. But it tells you where people are really focusing their buying interest.
And Jared, I know you as you're wont to do over there with many of your various models, you like to watch interesting movements in the market like we had this week and gaps and things like that. I know you had some questions about VolDex as it pertains to gaps and market moves.
That's right. So Scott, I hope you can. I think this will be valuable for listeners and then hopefully for me too. But I was trying to think through hypothetically how your index would behave. How VolDex would behave, that is, if we imagine a day in which the market opens, let's say it's a few percentage points down, but overall implied volatility is already relatively moderate to high, and so we don't get a huge reaction in terms of the overall level. If we just imagine, let's say that the vol curve stays more or less where it is, so that the underlying jumps down a few percentage points, overall implied vol stays roughly static. If I understand VolDex correctly, it sounds like on that kind of situation, on a big jump or a gap, VolDex would rise because the at-the-money strike would suddenly be lower, as the underlying moved down, and assuming a normal, ordinary kind of skew curve, our at-the-money implied vol level would now be at a higher level of implied vol. Is that a correct understanding?
Is your question, would we move up the skew curve to essentially a lower strike price, a higher organic implied volatility, simply because the underlying is moved? Is that the question?
Right.
No, we calculate essentially a forward price that is the true at-the-money price constantly, and that is the at-the-money that we're always looking at. So it's irrespective of where the S&P was trading. Every 15 seconds, we are calculating the forward price for the S&P, and that's always going to be at the money. So if you might call it crux vol or at the money vol is really truly stable, then VolDex wouldn't move.
Okay. I guess I'm trying to think through. I mean, if a $100 option struck at 100% moneyness is priced at a given level today, and let's say that the 5%, 95% moneyness option is a couple of points higher, right? And we close on Friday, and let's say we open up on a Monday, and those individual options have exactly the same implied vol that they did at the close on Friday. It's just that now the index happens to be a few percentage points lower, hypothetically. It seems like the at the money strike prices that we would use would be lower strike prices in terms of the listed options. If those implied vols at those lower strikes remained a little bit higher, I guess I'm not sure I understand how our at the money vol index would be the same in that situation.
Well, if the question was if implied volatility hasn't changed, then VolDex isn't going to change. If implied volatility has truly increased, then VolDex will increase. So, the idea is that the overall curve has remained where it is, but because strikes that are further out of the money, at least on the put side, tend to be priced at higher levels of implied vol than a given at the money at a present time. If we assume that the options prices remain the same, the implied vols at a strike level remain the same, but we change which strike counts as at the money because the underlying moves, it sure seems like the level that we would define as 100% moneyness at that point would be a higher level of implied vol. So I'm not sure if we're kind of crossing, talking at cross purposes in terms of jargon or not. But do you see what I mean in terms of the curve remaining the same, but the level that counts as the at the money level changes? Well, I'm not certain I understand the question, because if the implied volatility of the at the money option has increased, because it would increase because the market did fall. So the fact that the entire skew moves up and down what we call the vol slope, so that the at the money implied volatility is changing because it moves up and down that vol slope, then at the money implied volatility has changed, and VolDex will express that. The important thing is that VolDex will express that. It won't express that plus skew, plus tail risk, plus people selling calls and slamming the call skew in an effort to get short deltas. We won't have the informational advantage generated by VolDex muddied by all those other things going on.
Okay, thanks.
Okay, so this is Andrew Giovinazzi. So as an old SPX trader, what you're saying is the VolDex will basically follow your path down your sheets, right? Your curve down your sheets when the underlying moves. It will follow that path of the at the money, and that will change the value of VolDex. If we have the whole curve shifting up, that means your at the money is going to shift up. So VolDex is in a way, though, sensitive to, I think, Jared's question. It is sensitive to a price of the underlying, because as you have kind of that sticky volatility per strike, if you go down, that's, the at the money vol is going up, and VolDex will reflect that, but only on the at the money. You get rid of all the other extraneous strikes, and you just focus on, where the at the money is at any given point in time.
That's right. And I used the term vol slope before. I mean, option traders for a long time use what they call vol slope. That is, they automatically added implied volatility to every option that they were making a market in as the market fell, and they took implied volatility out of every option as the market would rally. And they did that automatically because it more accurately expressed how the market really works. And so if the market falls, then implied volatility is going to go up.
Okay. So I think Jared's got his answer, I believe anyway. That's how I would how I would look at my sheets when I was trading the SPX. So you go with the key part for the differentiator for the product is you, at least in the VolX, I want to make sure I say it right, because I actually look at it. My clients like the SDEX a lot. We've been following that, but you're really narrowing on the at the money, and you're saying for VolDex, and you're saying forget everything else for this particular.
Well, we're saying that VolDex crystallizes implied volatility. It measures it the way 95% of market participants do. And again, the complexity inherent in the VIX is not a bad thing. We just think our measure is substantially better. Otherwise, we wouldn't have bothered. If we didn't think we had created a better product, we simply would not have bothered. We'd much rather look at the components of volatility separately so that we can really see what's going on.
Okay, so if I ask this question, is it fair to say that VolDex basically just tells you that 30-day forward price of the at the money straddle, takes that and generates the implied vol for it? Is that basically accurate? Is that 30-day straddle an $8 straddle, is it a $9 straddle, a $10 straddle, making it either 14 vol, 15 vol, or 16 vol?
Well, then, no. I mean, we actually calculate VolDex in a way that's quite a bit more sophisticated than that. The way to do it that you've suggested, you'd have to actually plug all those numbers into some sort of option pricing model, and then through trial and error come out to a number. We use a closed form solution that's much more sophisticated than that, and there's no trial and error. We actually come up with we put the inputs into the equation. We come up with a number that really expresses what implied volatility is.
So, but like for the layman, right? So we've got a bunch of people listening to the show, and what I'm trying to give them is an easy way to picture this vol number. And, I know you guys are, the methodology is different to calculate it. But, because you are using a 30-day forward number on where you generate the value, essentially, that has some value. I'm trying to just get it, like, listeners to think of it in sort of simple terms. Like, you've got the VolDex trading almost 17 right now. And funny enough, 3 weeks ago, it was trading under 10. So, trying to get them to think of what that means in like real world terms. What's that, that sub 10 level straddle relative to the 17 level straddle that we're pricing now?
We don't look at it in terms of a straddle price. But I will say this: we measure the implied volatility. Compare that to the VIX, which ends up with a number that's an amalgamation And there's nothing that on your screen that you can look at and say, with the VIX at 18 or wherever it is, this is what that tells me. That's not the way it works, again, because a couple of Fridays ago, for example, I started counting the number of options that went into the VIX calculation, and I just quit when I got to 400 because that's all I needed to know. VolDex, on the other hand, uses as inputs the price of 4 different options, and those are the at the money, the first out of the money put, the first in the money put in the next 2 expirations, and so much. It's a number that's much easier to understand because it really is analogous to implied volatility. Well, the VIX is not. The VIX is an amalgamation of a whole bunch of different options that are all weighted by strike price.
Scott, it's been kind of an ongoing debate we've had here on the show, and we've had a lot of different guests weigh in on it over time, both pro and con. And that is kind of what you're alluding to here, that discussion of whether the VIX is indeed a pure representation of implied vol, the S&P, or if the tail is starting to wag the dog, not just in terms of the skew, which you clearly view as, but also some of these other things like the flow coming out of these ETFs that are flowing back into things like the S&P and the SPX, and if that's impacting the VIX, and a lot of other things are starting to pull VIX in a lot of other directions that maybe some people may agree or disagree that is somewhat different from what the pure implied vol of that product is. Obviously, I'm guessing from your comments today that you definitely fall in that latter camp. You think the tail is starting to wag the dog out there in VIX land.
Well, I think that the VIX obviously has problems because it's not investable. Which means that there's this giant basis problem. That is, the cash VIX that everybody sees on their screen is divorced from the price you would pay if you actually wanted to get into some sort of investable product, whether it was the futures or an ETF or an ETN. And we expect that, based on the way VolDex works, that basis penalty will be much smaller. That's another reason that we created the product the way that we did. So to the degree that people want to use VIX or VolDex tactically, then I think that the penalty is, even in VIX, is relatively small. But for people who want a more strategic long-term holding, the penalty caused by the basis, that is the difference between the cash VIX and the VIX futures, is just overwhelming. It's almost impossible to overcome. So we think VolDex is going to be a better solution for those people as well.
And, we've been talking mostly about VolDex here, but you repeatedly mentioned also the Skewdex and the Taildex. Walk us through those really quickly. Is the Skewdex, for example, how is that calculated? Is that just your typical 25 delta call out in SPY and 25 delta put, like your typical risk reversal? And how does that equate to something like the skew index that the CBOE puts out?
Right. No, we actually measure skew in the equity index world a little bit differently than you've described. When we always asked about skew, we were trying to compare an out-of-the-money put option to the at-the-money implied volatility, and that's what Skewdex measures. It's the cost of the one standard deviation out of the money put compared to the at-the-money option. So that's how we measure skew in Skewdex. And we think it's an important measure of how risk-averse people are. Do they demand at-the-money hedging opportunities, or are they willing to go out of the money a little bit? Taildex measures the cost of a 3 standard deviation out of the money put in the S&P. And we think that that's a really important measure because it explains exactly how much people are willing to pay for that sort of protection. But VolDex is the product that our partner, the International Securities Exchange, has received clearance from the SEC to offer derivative products on. They received that clearance earlier this year, and we're looking forward to working with ISE to offer derivative products on VolDex. Those are going to be the first products that are actually tradable that we're going to roll out.
Now, Scott, you mentioned the futures on the VIX side before. That's obviously an area where we've seen some of the other entrants into this space kind of stumbles when it gets to the underlying. That's where the devil meets the details in a lot of capacities. What are your plans for the underlying on this? Because that's obviously going to help drive a lot of volume back to it. Is it going to be an ETF? And do you have any sort of plans for that you can share with us now?
Sure. And again, ISE has been a wonderful partner, and they've received clearance to trade options on VolDex. And right now, together with the ISE, we're talking to futures exchanges about offering futures on VolDex. And we expect to have that piece of the puzzle solved very shortly. And we will be certain to let everybody know when we can publicly talk about that piece of the puzzle. But we realize that that option traders have to have a way to hedge up their deltas, and we're going to have that solution figured out really quickly.
I'm glad to hear it, because like I said, that's where we've seen a lot of other entrants encounter some issues. So clearly you guys have thought about that. Really quickly before we wrap up here, there have been a lot of other high-profile people starting to make some claims on the volatility space. We've, of course, seen Professor Whaley talking a lot about his product, not a direct competitor to what you're doing, but more attempting to essentially solve that roll yield conundrum that a lot of people discover when they start trading a product like a VXX or some of these other big VIX ETFs and ETPs. What's your take on a product like that, and is there room for it in the landscape?
We have talked to those guys about their product. They are all very smart. These two fund solutions have been tried before. We're anxious to see how Dr. Whaley and his group end up. The previous iteration of that sort of solution didn't work out too well. If they can end up with a solution that solves these problems, then we're anxious to work with them. We're anxious to work with them on that product. We also are anxious to work with current VIX traders. We think that there are going to be tremendous spreading opportunities between VolDex and VIX.
That was actually going to be my last question there. How do you view this shaping up in the marketplace? If all goes as planned and you launch this product, do you see it as essentially cannibalizing a lot of share away from VIX, or perhaps the alternative is being additive? Some guys out there trading the VIX against the VolDex and taking advantage of, let's say, the Skew Plus product versus the Skew Less product. Sounds like you view it more as the latter, kind of a additive type product.
Very good question, and that's absolutely the case. We think that there are going to be traders who are organic users of VolDex and want to use it for the very reasons we've described. But we think that there'll be a tremendous number of traders who want to trade one, spread one against the other. As you pointed out, if you wanted to isolate the impact of skew, whether you thought skew was rich or cheap, then you could spread VolDex against VIX and you'd be able to isolate the impact of skew. We think that there are going to be tremendous spreading opportunities. So we think that we're going to increase the size of the pie when it comes to volatility trading, and our goal is to just capture a reasonable portion of that much larger pie.
I like the spreading idea. That sounds kind of interesting. How you'll be able to kind of carve off the downside part of the VIX. My other question is how do you make it? I mean, if I was betting man, I'd say you probably have to have a future on this index. Obviously more retail interests they would care about the ETF. How would you even go about trying to create an ETF on this to generate? I mean, I guess you could go to the underlying, you only got 4 options, but it would be an interesting, it makes my head swim a little bit how you could create an ETF on the index. And that's not possible, but.
I think there are a couple of ways you could do it. One is you could use the options. You could use the VolDex options. You could use the constituent options. We expect to have a futures partner established shortly, so you can use the futures. The thing about VolDex is you could express your point of view in any number of ways that you can't with the VIX.
Got it. Okay. All right. Thanks.
Well, Scott, I'm glad you can make it on. We ran a little long, as you can tell we're very interested in this product and how it's going to shape up in the space. So we'll definitely be paying more attention to you guys as you go forward and your partners over there at the ISE as you make more announcements, determining a time frame and an underlying and all that kind of stuff. And maybe we'll have to bring you back on again down the road a little bit when all that's a little bit more finalized. We can dive into the details in a little bit. In the meantime, if someone listening wants to learn more about what you guys are doing, where should they go?
They can go to our website, nations.com, and we have quite a bit of information there about VolDex and actually all of our option price indexes.
Well, great, Scott. I'm glad we can get you on, and I'm looking forward to seeing this product hit in the marketplace and seeing how it shapes up in the volatility landscape.
Thanks so much, Mark.
All right, and that is going to do it for the Volatility Viewpoint segment, an interesting one indeed. And now we're going to keep on rolling right on into the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, listeners, we went a little long on that segment, but there's a lot to dive into there. But as Jared alluded to at the top of the show, this was a crazy week from a pure vol perspective. We could probably spend at least an hour just reviewing the activity that went on this week. We have a little bit less time than that. We got about 20 minutes, so we'll see how much we can squeeze in. But it was just madhouse week. We are, of course, recording this Friday, October 10th. This week, Thursday and Wednesday were really just crazy weeks. You saw the market rallying aggressively on Wednesday the 8th, and then selling off even more aggressively the following day on Thursday the 9th. And vol, as you might imagine, just through the roof, implied and realized. It's been just a madhouse range. We've seen the VIX Cash vacillating all over the place from a low, I believe, of about 1405 to a high in almost 19.4 roughly out there. So it's just been a crazy week. The VIX Futures all over the place. At one point, VIX Cash was pretty much higher than just about every other VIX Future out there. And I think until you got all the way out to April or so. So it's been just crazy time from a volatility perspective. I'm not sure even where to begin. Maybe, Jared, we'll start with you. What in this crazy week caught your eye? And pretty much we can probably spend the next 20 minutes just talking about that.
Yeah, I know it's hard to know what there's such a wealth of things to talk about, what to zero in on. But maybe I'll just start with this little fact. So looking at implied vols in the S&P 500, all the stocks in the index, I can remember a point not that many weeks ago where if you just ranked those stocks by where each individual stock's implied volatility was versus its own history over the past several years, you might have 5, 10, maybe even 20 stocks ranking in the top decile, above that 90th percentile level where they had some relatively rich premium. I pulled up the list just before the show. I counted 83 stocks in the S&P 500 now that have options trading above the 90th percentile compared to the last 3 years of each individual stock's history.
Wow.
So
that's just crazy, but also probably about par for the course for what we saw this week.
Absolutely. So when you see that's more than 15%, it's like 16% of the stocks in the index now trading with what anyone I think would call relatively expensive, relatively richly priced options, at least on that basis alone, not looking at realized vol. But so you've seen a very broad-based move in the options market. What's interesting to me is that one of the big dynamics that we talked about last week. I mean, I think I mentioned we had a report titled "Preparing for a Volatility Regime Change," and I certainly wasn't expecting something this big this quickly.
Your wild prognostications are a little less wild than you thought.
Yeah. So I'm not gonna take credit for calling something this soon, but we also talked about what the international markets were looking like, and I noted that emerging markets, for all the worries about growth, did not have options priced at particularly expensive levels, given the realized vol that we were seeing. And that remains a little bit true in some cases. We're finally seeing a move up in premiums in China, for example, over the last 2 days. But realized vol has been moving there at a healthy clip, and a lot of the options markets just haven't moved much faster. They've been kind of in tandem. So from my point of view, that relative value outlook remains the same even after all this movement in the market.
That certainly is interesting stuff. Andrew, I know you guys have been pretty busy this week as well, just watching all of these insane vacillations in all of the myriad of volatility products. What amongst all that activity this week really caught your eye?
Well, I mean, the biggest jump was just the kind of decimation of the whole energy producer, explorer, well service, drill service providers, all that stuff. I mean, I wondered what percentage of the data that Jared was looking at that were those types of stock in the S&P 500. But all of a sudden, it feels like somebody pulled the plug on them. I don't know if this morning was the bottom because there's some bounces in that sector, but huge. It's like all of a sudden we've got too much oil. It was a really strange, I don't know how that happened. I guess just it's coming out of the ground and getting to the wellheads and all that kind of stuff. Good old supply and demand. As we've been talking about, the U.S. is producing their own oil and is ready to be a net exporter. And it hadn't done anything to the price of oil, really. I mean, as early as the spring, we had some, pretty high oil prices. So it feels like there's a funky combination of things. I don't know what's really changed a lot in the emerging markets too, but you're starting to see a little bit higher volatility. It's out of the teens into the low 20s, let's say, but nothing too out of hand. But there again, that's where we are. We have a lot of, there's somewhere along the lines, people have gotten freaked out, and I'm not sure if it's Ebola virus or which apparently you really can't catch unless, you come into some sort of, we'll just call it intimate fluid exchange type contact with people. I've read anyway. So, but there's all that stuff tends to weigh on the market a little bit. But yes, we've seen vol go up. Like an option put, we try to avoid selling a lot of vol. I don't like really selling vol until it goes down. So, generally some kind of back spread or something like that. So, or if anything, if you sell the physical options, something way out of the money, like an iron condor type thing. But for the most part, it's almost like, and I think I had a client that sort of said it best. It's like bad news, usually coming out of the Fed, bad news used to be good news because of rates. And now all of a sudden, with equity valuations sort of where they are, they're like, well, wait a minute. We're sort of getting used to the idea of that rates have to go up because there's economic growth. And now you're telling us you're worried about, the rest of the world. And I think it caused everybody to freak out a little bit after they sat back and looked at what that meant. Because that, I think, is the only real, what I will call just different outlook type news that we've seen this week. So, but it was enough to make the markets move. And it hasn't stopped.
Yes, that's to spook a few people. As we're recording this today, listeners, the market a little bit quieter. The S&P and the Dow both pretty much unched on the day, up fractionally or down fractionally. Qs look like taking it on the chin a little bit, down 1.3%. I'll have to check, see if my quotes might be a little bit off on that for some reason. But Qs taking it pretty hard. And it was an interesting week just from an overall, options perspective in the volatility realm. VIX, as you might imagine, lighting it up this week from a volume perspective, doing nearly 1 million contracts yesterday on Thursday, which is pushing it close to record territory there. Didn't break it, though, which is interesting. I thought it might break into that realm, but it did not. Came very close. And today, we still have about an hour and change left to go in the session, listeners, and already doing about 750,000 contracts out there. So fairly robust time from an overall vol option perspective. We'll get into some of the other products in a little bit to see if they followed suit. You may remember as well, listeners, last week we talked about some size, just crazy size upside call buying in VIX to the tune of the OC19 calls paper coming in and buying them, I believe it was 457,000 times for about 86 cents. It was through the offer. It was crazy paper. What we saw this week was some of that coming off a little bit or maybe legging into a very tight spread. We saw some of the biggest trades we saw on VIX Options land this week were the OCC 20s going up this time, and yesterday on Thursday they went up almost 90,000 times. Looked like paper selling for prices in the 81 to 83 cent range. So yeah, about 86,000 and change going up yesterday in two massive trades. So maybe that guy legging into some spreads, maybe he's giving up the ghost. He clearly has some bullets to go on the upside if that is indeed the case. And near term at least looks like his bet on VIX upside perhaps not working out, but when a bet's that big, it's got something else cooking on it on the OTC side probably. So he probably is smiling at the end of the day. We also saw a lot of interesting stuff. We're seeing some interesting trades going up today as well, including looks like some of the larger trades out in VIX land include looks like a time spread here, a Nov Jan 22 call spread going up for about 55 cents or so, about 10,000 times. Paper buying Jan, looks like. So seeing some interesting spreads going up. We saw some interesting stuff going up on Thursday as well. People dumping some Nov 22s and legging into perhaps some Ds 25. So people taking opportunities here to perhaps dump some of the crazier parts of the near term of the futures curve and leg out into some areas where perhaps the bid has not been as crazy aggressive. Really quick here, looking at the top hot strikes out in VIX land. Nov taking the top spot this time. Nov 20s to be precise. Even with all those OCC 19s and 20s trading, Nov 20s still leading the charge. 364,000 contracts take the number one spot, followed by the OCC 17s. About 340,000 contracts. OCC 20s, they're number 3. 283,000 contracts. OCC 18, number 4, with 254,000 and almost the exact same number of Nov 17s for number 5. Then we roll out to Jan, 248,000 of the Jan 20s, and then OCC 21s, OCC 22s, and OCC 19s take the 7 to 9 spots, about 224 down to 194. And the final one puts back on the top 10 chart for the first time in a while. The Ds 13s, that seems to be the strike du jour. That's the only put strike that really has any relevance, it seems like, doing about 182,000 contracts open on that strike. A total of about 8.46 million options trading, about 6.3 calls versus 2.17 million puts. Really quick, Jared, before we move on to some of the other products, anything catch your eye in the OTC realm this week?
Yeah, we looked at what was going on in the variance swap land, S&P variance swaps, and there were some trades that went up, although it was a little bit quieter on Thursday than you might expect. But before I wanted to. Andrew brought up a great point about energy and the punishment that some of those stocks have taken. So I just pulled this up real quickly. So of about 250 listed U.S. energy oil and gas sector companies, it looks like roughly a third of them have 1-month options priced in the top decile versus the past 3 years. So we said earlier that in the overall S&P, it was about 16% were priced that high. In the energy space, you're talking about more than a third of the energy companies have options priced at those extreme levels. So that gives you a sense, I think, of the relative size of the reaction and extent of the reaction in the options market to the weakness lately in energy. I think that's definitely something to watch for the near term.
I know that's certainly something that's been catching Andrew's eye quite a bit over there, just essentially almost just giving up the ghost in the energy. We'll jump out to that in a minute. Really quickly here, we'll just wrap up with some of the vol products. VXST, not perhaps leading the charge as you might expect, given the week that we saw where it was just really, really near-term, really aggressive. Realize vol coming back into the markets, you think you might want to play a short-term product like that. Not so much. We saw about 1,500 contracts going up on Thursday, the craziest of days, the same day that the VIX mothership was doing about 1 million. So VXXT still, for whatever reason, even on days like Wednesday and Thursday this week, not catching fire. The top strikes, the hot places out there to play are the 15 puts, actually. The OCC 15 puts expiring on the 15th there, the week of the 15th. And then we see the 21 calls, 1,000, and the 23 calls, all open essentially for 1,000. And that's pretty much it in terms of size paper. Only less than 4,000 contracts open total in this name. So VXST still not catching fire for whatever reason. I think a lot of people thought maybe this week would be the week, but apparently not the case. Let's jump out to energy land because that's where a lot of the action has been. We talked last couple episodes about what we're seeing out here from a crude vol perspective and nat gas a bit. Looking at the charts here for Skew, and once again, crude, as Andrew and Jared alluded to, just take it on the chin. It's south of the 90 handle, well south of the 90 handle, down to 85 range and even below these days. And as we talked on recent shows, the puts are where a lot of the love is. The puts are still where the love is, even as we continue to roll down this skew with most of the crude products hovering in the low 20s to the mid 20s range from an at the money implied, and then getting up there pretty far when you start talking about puts, particularly in some of the nearer portions of the term structure. Some of those puts get pretty pricey, up to somewhere around a 30 vol and even beyond. Some of these crazy near term puts going for about a 35 vol or so. So fairly heavy out there in skew land. Jared, does that surprise you at all? I know last episode you were surprised that the puts weren't catching more of a bid. Are you still surprised this week at that?
No, and you know what I noticed is that it seems like the traders on the call side have really given up relative to what they were pricing in even a week and a month ago. Looking back at the historical curves, we saw a fairly ordinary kind of a smile with out of the money calls priced a little bit higher in implied vol terms, just like on the put side. When I looked at it this morning, it looked almost like a stock, really, than just a regular equity options skew curve, because you had plenty of bids, plenty of higher implied vols in the put wing, and calls were actually bid lower, which suggests to me that the market, at least for the very short term, is not prepared to price in any kind of a snapback rally, even at a relatively modest percentage move basis for crude oil. So it looks like the options markets are taking this pretty seriously, and there's not a lot of demand for upside calls as the move continues.
Yeah, if you just threw this chart in front of me with no labels and said, guess what it is, I would certainly guess it's an equity, because it looks just like that. You're right. This has all the hallmarks of typical investment skew. And that's not something we see very often out there in commodity/crude land. So that's worthy of note in and of itself. Andrew, does this pretty much feed into your hypothesis that someone out there has given up the ghost in the energy land?
Yes, I think somebody with a pretty big bankroll. I don't know. Did Bill Gross leave PIMCO and they're dumping all their oil and energy-related stuff? We'll see if today is kind of the bottom. Maybe there was an accumulation of this stuff because of inflation, and possibly we've got the inflation ghost is kind of dead. I mean, the TLT is about to trade 120. If it hasn't, it got close to printing that high. We're near the highs of the day, so. Not seeing a whole lot of inflation type action from those major products. Oil down to, what are we trading? Is the spot price like $89 an hour? I thought I saw 85 or 84 this morning.
It hit 85 recently. I don't have it up where it is today, but it did get down that low very recently.
So yeah, 85.76, and it traded below 84 today. So they're definitely, somebody's bailing. Continued selling, but overall lower energy prices now might be bad for a couple of sectors for stocks anyway in the U.S. economy. I don't think it's going to stop us from producing the level of oil and growth that we've had. It's just, I still think they're making money pulling out of the ground at $60 a barrel or something like that, depending. So that's a long way to go. OPEC and we haven't seen them pull in their production either, which I find odd. But the U.S. is certainly not worried about decreasing their production when OPEC does theirs. So that might help us open the floodgates now that there's a new player on the block. So I think the market is, obviously the indexes are getting pushed down because this is a fairly big chunk of market cap in the S&P 500. It's getting smacked pretty hard. And it's just why and when. I still don't have the complete story to my satisfaction on why they're hitting it so hard. But at the same time, all the financials today, the XLF is down a penny. And it's still, it's not at its highs, but it's relatively close. So maybe there's a little bit of a shift going on, and we'll see how it plays out. But consumers like low oil prices, and so do all the industries that consume it. So it should be good, right? We go back to good news should be good. So it's this rate issue. and some of the confusion by the Fed when they come out with all these conflicting reports. I think the market has a hard time with it. The market hates uncertainty, and the market hates it when the Fed is not certain about what they're going to do. So, and that's where we are.
Oil taken on the chin. We can all go out and buy Hummers safely again. The world is safe for massive SUVs once again. All right, unfortunately, that's all the time we have for the Vol Review, listeners. Now we're going to dive into a really quick crystal ball segment.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, listeners, you know the drill. This is the portion of the show where we prognosticate recklessly and indeed wildly. And on a week like this, this is probably the most dangerous part of the show. So maybe if you have children around, maybe you want to cover their ears for this portion, because this is where it gets pretty crazy. And when you're thinking of crazy, wild, reckless prognostication into the future, you're thinking Mr. Jared Woodard. Jared, you're up first, sir. What's your reckless and wild guess, sir?
Well, all right. So I don't know what's going to happen over the next week. I'll tell you that. What I do know is that some selective energy names look attractive. And I know that the general interest in VIX, as always happens in these kind of situations, sort of general news, general investor interest has really spiked. I think just anecdotally today, this morning. So it may be that unless we get some new catalyst, growth scare is the phrase of the day, that the market quiets down next week. You remember, people forget sometimes, I think, that it takes quite a lot of movement in the market on a price basis to justify high and rising options premiums. And so if you don't get that, that gravity effect, so to speak, starts to kick in and premiums start to come down, and that has immediate implications for volatility products. So it would be not at all remarkable if next week the market was a little bit quieter, vol came in a bit. But with that said, we put out a note this week that one of our long volatility signals that we watch had triggered for the first time this year. And so I think, and because of the reaction in the market, some upside skew in the VIX made it cost effective. So I'm really legitimately on the fence in terms of short-term expectations, and I don't think there's anything wrong with that.
Defending himself, I like it. Andrew, Jared took the safe route. Indeed, he wussied out today. So your turn to go crazy. Go big or go home, sir. What do you have for our listeners?
That's very un-Jared like to wussy out like that.
I
know. So I'm just gonna say I'm looking at the vol futures and I'm looking at the October future. I think trading at a short-term high now, 1835. I'm almost sure that's the high tick for this product. Not 100%, but I'm pretty sure. It is now leading, and I bet you it's going to close above all the way to February. So, normally you see that kind of backwardation, and the market is still primed to move. So expect more realized vol. I've got kind of little vol back spread, so I'm just sort of waiting until it moves a lot one way or the other. We still are under the cash VIX. That's the bottom line. So under the cash VIX, I have to say, normally that we're expecting that vol to move between now and October expiration, which is now, 9 calendar days? No, it's 12. It's 12 calendar days from now. It's the Wednesday after next. So sure, VIX can be a little, vol can be a little lower, but I'm going to say next week we're going to see the 20 handle in VIX again. Right now, we saw it today. Normally, VIX doesn't hit 20 once, it hits 20 twice. And I think we're going to see it again next week.
That wouldn't be too far out of the realm of probability. I mean, the 10-day realized creeping up there, 19, even the 30-day realized creeping up to a 13 today. So we're starting to see some actual vol in the marketplace. And how long have we been talking about, 5 or 6 levels of realized for the last couple of months, it seems like. So starting to see some real vol. So I wouldn't be surprised, I don't think anyone would be, to see VIX Cash take another bid early next week. Unfortunately, that's all the time we have for this episode of Volatility Views, listeners. But before we go, as always, let me check in with each of my cohorts here, including the fence sitter, and he's proud of that, Mr. Jared Woodard. to see what they have cooking and coming down the pike for you. Mr. Jared, what's coming down the pike over there at BGC Partners?
Not that there's anything wrong with that.
That's my mantra for this episode.
Okay, so I mentioned earlier our note preparing for vol regime change from last week. There's some good stuff in there I thought that people seem to have responded to. We actually came up with 2 additional pieces this week that I just have to mention, looking at the returns to IPOs around the dates of the expiration of lockup agreements. I think I mentioned that last week. I finished the work on that, and it came out, and I think that's an interesting area to cover that I haven't seen a lot of work done. We actually updated the research from the dot-com era, looking at IPOs since 2009. So some legitimately new work, as far as I can tell, on that front. And then also a note looking at the VIX on a more short-term basis, with all the trading happening this week. So a pretty productive week, and I have no idea what we'll do next week, although it'll probably have something to do with energy. So clients can definitely look for that.
And we're still waiting for our straddle study going into earnings. I believe I cut you a check for $5, sir, so I'm awaiting that with bated breath, sir. Money well spent as far as I'm concerned. All right, Mr. Giovinazzi, take us home. What's coming down the pike in the land of the pit?
Early November, we will be having, in December, we'll be having our boot camp again. And in early November, we will be having Mark and I are still talking about it, but I think a put selling class on, what to look for. Definitely with a retail bent on the things we look for when we sell puts, when we sell spreads, when we sell anything downside. And you look at a market like this and you say, oh, no. But yeah, there are puts that can be sold. There is some volatility that's higher, much higher. Maybe the energy space is not too bad. I like to see it stop going down before I sell any puts. Hint, hint. That's something that we look for when you sell them. And we'll see how it all goes from there.
All right. Thank you for that, sir. And, of course, I want to thank our guest as well, Scott Nations, for coming on. It was a fun segment. I have a feeling we'll be talking about that product again down the road. And on behalf of Andrew and Jared and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show and for sending in such great questions. I apologize. We went a little long on the interview today, so we didn't get a chance to get to your questions. We'll get to them next week, and we'll, of course, see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.